While most investors are still focused on interest rates, inflation, and whether Bitcoin can break to new highs, something much bigger is quietly happening underneath the surface. Major financial institutions are expanding into crypto. Traditional brokerages are integrating Ripple's payment infrastructure. The XRP Ledger just crossed a milestone that very few people expected. Japan's largest financial groups are making billion-dollar acquisitions, and across traditional markets, the Dow Jones and Russell 2000 are quietly printing fresh all-time highs. Today, we're connecting those dots, because sometimes the biggest moves happen long before most people realize what's being built. Nothing in today's episode is financial advice. Everything discussed here is for educational and informational purposes only. Always do your own research before making any investment decisions. Welcome back to Ledger Pulse, where we break down the biggest developments across crypto, blockchain, and macro markets, making sense of the headlines and connecting the stories that could shape where this industry is heading. Today's episode has one common theme: infrastructure. While price captures everyone's attention, infrastructure determines where the next decade of capital eventually flows. Let's begin with the bigger picture. Crypto analyst Matthew Hyland shared a chart this week that caught a lot of attention because it compares today's market structure to the setups that preceded the major crypto bull runs of 2016 and 2020. His comparison looks at several indicators, including Bitcoin dominance, altcoin dominance, Ethereum versus Bitcoin, and how crypto has historically interacted with broader macro conditions. Now, this isn't about saying history repeats itself perfectly. Markets never move exactly the same way twice, but they often rhyme. Analysts study previous cycles because they're looking for probabilities, not guarantees. They're asking whether the conditions that led to significant upside in the past are beginning to appear again. One thing history has consistently shown is that the early stages of major market advances rarely feel exciting. They usually begin when sentiment is cautious, when headlines remain negative, and when many investors are still waiting for another major pullback. Whether this cycle follows a similar path remains to be seen. No chart can predict the future with certainty, but it is an interesting observation that several long-term indicators are beginning to resemble previous periods that ultimately turned into significant expansion for the crypto market. It's another reminder that markets often begin changing direction long before the majority of investors recognize it. Another perspective this week came from longtime market analyst Blockchain Backer. He argued that what we're seeing today resembles what traders often refer to as maximum pain. Not necessarily because prices are collapsing, but because investor psychology has become overwhelmingly cautious after months of volatility. His point is that after enough corrections and enough negative headlines, many people begin expecting every rally to fail. Confidence erodes, investors hesitate, and eventually, even positive developments are met with skepticism. Ironically, that's often when markets can surprise people the most. If enough investors remain on the sidelines waiting for one final drop, the market doesn't need everyone buying to move higher. It simply needs more buyers and sellers. That doesn't mean blockchain backers guaranteeing a bottom is in. Nobody knows exactly where prices go next, but his broader point is worth considering. One of the biggest challenges in investing isn't reading charts, it's managing emotions. Fear has a way of convincing people that waiting just a little longer always feels safer, even if the market has already started moving in the opposite direction. Whether you agree with his outlook or not, it's a valuable reminder that understanding market psychology can be just as important as understanding technical analysis. Now let's zoom out beyond crypto. Both the Dow Jones Industrial Average and the Russell 2000 have recently reached fresh all-time highs. Why should crypto investors care? Because crypto rarely exists in isolation. When capital becomes more comfortable taking risk, that appetite often expands beyond stocks. Small cap companies, technology, artificial intelligence, digital assets, these areas often benefit when financial conditions improve. It's another reminder that crypto isn't competing against traditional finance anymore. Increasingly, it's becoming part of the same global financial ecosystem. This week's institutional news may have flown under the radar. Franklin Templeton completed its acquisition of crypto investment firm 250 Digital. It also launched Franklin Crypto, a dedicated digital asset division focused on actively managed strategies for institutional investors. That matters because this isn't simply another investment fund buying Bitcoin. This is one of the world's largest asset managers building permanent infrastructure around digital assets. Large institutions rarely invest heavily in departments they expect to disappear. Instead, they're hiring, building, expanding, preparing for long-term participation. These decisions usually happen years before the broader public notices. Another major headline came from Japan. SBI Holdings announced plans to acquire Bitbank in a deal valued around $289 million. The acquisition would create Japan's largest cryptocurrency exchange by assets under custody. Japan has consistently been one of the most crypto-friendly developed economies. Rather than treating digital assets as a temporary trend, many Japanese financial institutions continue integrating crypto into existing financial services. This isn't just about one acquisition. It's another example of consolidation as the industry matures. Now let's shift to Ripple. One report this week claimed that a multi-billion-dollar brokerage, Caleb & Brown, integrated Ripple-powered payment infrastructure into its back-end settlement systems. As always, it's important to separate confirmed facts from community reports. But regardless of individual announcements, the broader trend remains consistent. Ripple continues expanding relationships focused on cross-border settlement, liquidity, and enterprise payments. This highlights an important distinction. Most people judge blockchain networks by token prices. Institutions usually evaluate them differently. They ask questions like, can it settle transactions reliably? Can it reduce costs? Can it operate around the clock? Can it integrate into existing financial systems? Those are infrastructure questions, and infrastructure tends to compound quietly over time. One of the more interesting data points this week involves RLUSD. According to reports, the XRP Ledger has now overtaken Ethereum as the largest host network for RLUSD supply. That doesn't mean Ethereum is becoming irrelevant, far from it. Ethereum remains one of the largest blockchain ecosystems in the world, but it does show something important. The XRP Ledger is increasingly becoming the preferred environment for Ripple's own stablecoin activity. Stablecoins are rapidly becoming one of the most practical blockchain applications. Payments, settlement, treasury management, international transfers, tokenized assets. Every increase in stablecoin usage expands blockchain utility beyond speculation. One announcement that deserves more attention involves formal verification on the XRP Ledger. Rather than simply testing software and hoping bugs don't appear, formal verification mathematically proves whether critical systems behave exactly as intended. Think of it this way. Most software testing asks, did we find any problems? Formal verification asks, can we mathematically prove certain problems cannot exist? For financial infrastructure handling billions of dollars, that level of assurance becomes incredibly valuable. It's another sign that blockchain networks are beginning to compete on reliability, not just speed. Ripple also appeared in discussions surrounding institutional finance events in Monaco, focused on tokenization and next-generation settlement. Whether it's tokenized assets, real-world assets, or faster settlement infrastructure, these conversations increasingly include blockchain companies alongside major financial institutions. That's a noticeable change from just a few years ago. Crypto is gradually moving from the outside looking in to having a seat at the table. The final story today may end up becoming one of the biggest long-term developments. Projects building on the XRP Ledger are exploring infrastructure that allows autonomous AI agents to complete payments securely. Imagine AI systems that don't just answer questions. Imagine software that can pay invoices, purchase services, receive payments, verify identities, manage financial transactions automatically. For that future to work, digital payments must become programmable, fast, secure, and available 24 hours a day. That's exactly the type of infrastructure blockchain networks are trying to provide. We're still early, but this intersection between artificial intelligence and digital payments could become one of the defining themes of the next decade. Looking across today's stories, a pattern begins to emerge. Asset managers are expanding. Brokerages are integrating blockchain infrastructure. Stablecoins continue growing. Japan keeps investing. Security standards are improving. Traditional markets remain strong. And blockchain networks are evolving beyond simple cryptocurrency trading. None of these headlines guarantee immediate price movement. Markets will still experience volatility. Corrections will still happen, but infrastructure rarely gets built overnight. It develops piece by piece, announcement by announcement, partnership by partnership, until eventually the market recognizes what's been forming all along. That's why it's worth paying attention to not only price charts, but also to the foundations being built underneath them. Because in finance, the biggest transformations often happen quietly before they become obvious. If you found today's breakdown helpful, don't forget to like the video and subscribe so you don't miss future updates. I'd also love to hear your perspective. Which development from today's episode do you think will have the biggest long-term impact? The institutional expansion into crypto, Ripple's growing infrastructure, RLUSD's growth on the XRP Ledger, or the convergence of AI and blockchain? Leave your thoughts in the comments below. Thanks for listening, and I'll catch you in the next one.